Alrighty. So in today's video, I'm going to be sharing with you a SPY option strategy that is specifically for you if you have a small account, right? So if your account size is under $10,000 or maybe even under $5,000, then you can trade this strategy. So what is this strategy that I'm talking about? Well, it's none other than the short put. Now, at this point, I know what you might be saying, right? You might be saying, Davis, what on earth are you talking about? The short put on SPY, that is going to take up a lot of capital, right? That is going to take up a lot of buying power. And you're right? As you can see over here, if you were to put on a short put on SPY right now, somewhere around 30 deltas, as you can see over here, the buying power, that means the capital that you have to put up for this trade, would easily take you to about $7,800. So how is it possible to put this trade on if you have a small account? Well, hold on to your pants, hold on to your horses, because I'm going to show you a workaround for this so that you can still trade the short put on the S&P 500 index. So before that, let me explain to you why first we might want to consider the short put strategy for small accounts. So first of all, if you will talk about the short put strategy on SPY, right, on S&P 500, you will see that over the long term, it is net profitable. Of course, there are times where the market has crashed, like for example, in 2008, this is the financial crisis. And then also sometime in 2020, there is the pandemic, right? During these times, the market will definitely go down. You will be down, right, in terms of your drawdown, right? You will be losing money. But over the long term, it's still profitable because the SPY or the S&P 500 is a positive drift vehicle, right? As long as the market continues to go up over the long term, which it wants to, then this strategy will be profitable. So let's take a look at a little bit more statistics on the short put strategy, right? So as you can see over here, this is a study done by the Tasty Trade team. And again, whenever we trade any strategy, we want to lean on numbers. We want to lean on statistics, right? Because these are objective. At least this way we know that if it has been profitable, at least especially if the tests have been done over a number of years, we know that the chances of it working out in the future is going to be higher compared to if you have no idea what is the statistics of a certain strategy. So as you can see over here, the Tasty Trade team have put on the strategy of the 30 delta put, and you can see over here the win rate is actually pretty high, right? It's about 85% if you hold to expiration, and if you exit at 21 DTE, it's about 78%. Now at this point, you might be thinking, if you put on the 30 delta put option, shouldn't the win rate be only about 70%? Because 30 delta also indicates that, at expiration, there's a 30% chance that this put option will be in the money, which means to say you'll be losing money. So the win rate should be theoretically about 70%. So why is it showing 85% win rate at expiration and 78% win rate at 21 DTE? Well, the answer is because there's the edge, whereby the realized move is often a time lesser than the expected move if you go for the DTEs that's 45 days and above. So the whole study down here is whereby they go to the nearest 45 DTE and they just put on the 30 delta put, right? They just keep selling the 30 delta put, and then whenever they expired or at 21 DTE, they'll close it up, they put on the new one again. And that is why you can see over the long term, you have a high win rate, and at the same time, SPY or the S&P 500 has kept going up. This is what you call a positive drift underlying, and that is why your win rate is also skewed to the upside. But for the purpose of trading this short put for small accounts, what we're really going to focus on is the 21 DTE, right? So why the 21 DTE? Because you have a higher return. You can get about 21%, right? As you can see, this study has done over quite some time. As you can see, it's from 2006 all the way to 2020. So this is easily more than 10 years. So if you actually take a look at the S&P 500 return, if you were to just buy and hold SPY for this same period, your average return would only be about 8 to 12% per annum. But when you do it with the short put, you actually get a much higher return. So that's also one of the reasons why we want to use the short put as opposed to just buying and holding the shares. The other thing is the largest loss. You can see down here that not only do you have a higher return at the end of the day, but you also have a much smaller max loss compared to if you hold to expiration. So that is why we want to focus on the 21 DT. We have a much better P&L volatility control, as well as our return is higher at the end of the day. Now, at this point, you might be asking me, but Davis, why not just trade the put credit spread? Right? Why do I have to trade the short put? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. And the answer is that yes, you can actually trade the put credit spread. And the put credit spread is a good strategy as well for the SPY, or rather for S&P 500. And you can definitely trade the SPY with a small account using the put credit spread. But there are a few differences as to why we might want to consider the short put over the put credit spread. Well, one of the reasons is that with put credit spreads, it's harder to roll your trade for a net credit once it's in the money. Right? So as you can see, if the market actually blows past your short put and it goes closer to where your long put is, it's going to be hard for you to actually roll for a credit, right? So I'm going to show you an example of what I mean down here. So let's just say that your short put is at $600, the strike price, and your long put is at $595. So how do you roll this? So to roll this, all you're doing is just closing out this position, and then you're putting on a new position. And let's just say we put it at the same strike price of $600 and $595 at a later DTE, right? A later expiration date. So that means what you're going to do to roll this is that you're going to buy back this short put and you're going to sell this long put. So when you do it this way, you're closing it out and then you put on a new trade. So I've simulated this on the option chain. So as you can see over here, this is our original position, right? This two down here is our original position where we have the 600 and 595 put credit spread. So when you're rolling it, what you're actually doing is that you are buying back the short put at the 600 and you are selling off the long put at 595. So down here says BTO or STO. It just means buy to open and sell to open. When you actually roll it, it should show BTC and STC. That means buy to close and sell to close. But because I don't actually have a position on, I'm just simulating it to show you. It shows BTO and STO, right? So this is something to just take note. Now, if you were to roll it, all you got to do is go to a later expiration date. So as you can see over here, now we have gone to a later DTE, which is at December 27, well, at least of this recording, I'm using these dates. So by rolling this, you close out the initial position and you need to open a new position. And the new position, basically we stick to the same strikes. So we are going to be selling the put option at 600 and then buying the put option at 595. So you're keeping the same strikes, but you're just rolling it to a further DTE. And what you notice down here is that you actually have to pay a debit, right? You're not able to get a credit for this rolling. And that's one of the downside of having this put credit spread, right? It's going to be very difficult for you to roll. And you notice it's 4 cents at the mid. Chances are you won't get filled there, right? You might say, hey, 4 cents is very little. It's okay for me to just roll at a debit, a very small amount, and then just prolong the trade. But the thing is that you're unlikely to get filled at this 4 cents. Most likely you're going to get filled somewhere in the middle here, which is much closer to around 10 cents, right? So you're going to pay, and then that means the overall trade is going to be added risk as well. Now, what if you wanted to roll to a further out of the money and to a further expiration date? So as you can see over here, same thing, you will close out these two trades over here, which you have the original put credit spread. And this time, instead of sticking to the same 600 put credit spread, we have shifted the strikes lower, right? We have shifted it by 4 points lower. So now you have a new credit spread at 596 and 591. So we're still keeping the $5 wide put credit spread down here. So as you can see, if you were to roll out and you roll down, you're going to go into a bigger debit. So now you have to pay even more just to put on this position, which means this overall position is going to have added risk. So this is the downside of putting on the put credit spread. However, with the short puts, you can actually still potentially roll for a net credit, even though if you're in the money. So this is one of the things that a lot of people like to do, right? Because if you were to roll it in their mind, at least, is that they are actually not really taking a loss. Because every time you roll, if you get a net credit, you actually add on in terms of the potential profits you can make to the existing trade. So this is where the idea of rolling comes in. So if you were to take a look at the short put, let's take a look at the same example. If we were to see the same strike price at 600, if we were to roll out to a further date, you can see right now we easily have a credit. You can see that we have taken on an additional roughly about $1.86 in credit, which is pretty decent, right? As you can see, you are just buying back the short put which you initially have on, and then you sell the put option at a later DTE, right? As you can see over here, now we've gone out to the December 27, and we are still sticking to the same strike price. So this is the added benefit of trading the short put versus the put credit spread. Now, what if you wanted to roll out and down at the same time, which means to say you want to roll to a lower strike price? In fact, you can also do that, right? You can see over here, you are buying back the original put option, which you put on, and then you are selling a new one at a lower strike price. So now, not only does this trade become a slightly safer trade because you have a lower strike price, but you're also able to get an overall credit. As you can see, you can get 22 cents in terms of credit, and you can keep rolling this down, right? If the market doesn't go up immediately, over time, if it actually shows that you can get a credit, you can just keep rolling up and down until eventually the market recovers. And again, because this is the S&P 500, so over the long term, this positive drift, the market wants to go up. So when it eventually recovers, you're going to be in a profit. So this is one of the reasons why you might want to consider trading the short put. So now that we know that short put have an added advantage over the put credit spread because of the rolling, how can we actually use this strategy on the SPY, right? Because SPY, it's so expensive for us to put it on. As you have seen, is about 7,800. Well, the workaround for that is actually to trade it not on SPY, but on SPLG. So not too many people have actually heard about SPLG, but basically SPLG is pretty much the same as SPY. It's just that it's the smaller version, right? And as you can see, it's by the same people that created the SPY ETF, right? So this is by SPDR. So as you can see, the price of SPLG as of this recording is only $70. And if you were to compare this to SPY, SPY is actually around $500, close to $600 as of this recording. So this is so much cheaper compared to SPY, and that is why we can actually put on the short put strategy on SPLG. So let's dive a little bit deeper into what this SPLG is so you can kind of understand what it's about. So as you can see over here, SPLG is by the same people, like I mentioned, who did the SPY index ETF. Right, as you can see down here, this is all the same. And one thing good, an added advantage for the SPLG over SPY is the expense ratio. So let's say, for example, if you get assigned and you want to hold on to the shares, over the long term, it's going to be cheaper to hold it compared to if you were to hold SPY. And if you were to see SPY over here, so this is SPY, you can see that the expense ratio is about 5 times actually more expensive than SPLG. Right, as you can see, SPLG is 0.02%. But SPY is 0.0945%. So in this aspect, SPLG actually has an advantage. Now, what about the margin required, or rather the buying power needed for you to put on a short put on SPLG? Well, let's take a look. So if you can see over here, I have selected the 68 strike price on SPLG, which is somewhere close to 30 deltas, because 30 deltas is based off the Tasty Trade research which they used to get the kind of results which you have seen earlier. And to put on this short put on SPLG, you can see that all it takes is a buying power of only $840. So it's almost 1/10 the size of SPY. So if you have a small account, you can definitely trade the short put on SPLG. Okay, so now that we know that we can use the short put strategy on the S&P 500, how should we actually trade it? So I'm going to share with you the short put strategy on SPLG, and there are 2 methods for this. So method number 1 is timing the market. So how do you do this? So step 1, what you got to do first of all, put up the stochastic oscillator or the RSI, which one you feel more comfortable with. Pretty much the same. Then just wait until SPLG is oversold on the stochastic oscillator. And that means that this line down here, as you can see, has gone below the red line, which tells you, it's oversold. Then at this point, all you got to do, simply sell the 30 delta strike price. And this is according to the Tasty Trade studies, which I've already shown you. As you can see, they put on the 30 delta short put, and this is the kind of results that they have gotten. And you want to choose nearest to the 45 DTEs because this is the DTE which they have chosen for this study. And step 3, Very simple. Wait until 21 DTE, then you do one of two things. Number one, if it's in a profit, simply exit the trade. So why do we want to wait until 21 DTE to exit, and why not just hold to expiration, right? Because if it's in a profit, why not just realize the full premium of this short put? Well, because the studies have already shown if you actually held to expiration, your return over the long term, right, is going to be lesser than if you exit at 21 DTE. At the same time, over the long term, your loss is also going to be much more controlled compared to holding to expiration. So that is why you want to exit at 21 DTE. Now, if your position is in a loss, so chances are that the market probably has come down, right? Maybe even blown through your short put strike and you're now facing a loss, then this is where you can consider to roll your short put, right? So there are two ways to roll this. Either roll out to the nearest 45 DTE, keeping the same strike price. So this is what I've mentioned earlier. I've shown you in the example just now. We just roll out to a further DTE and we keep the same strike price. That's one option. Now, the second one is to roll out to the nearest 45 DTE and then roll down to a lower strike price. So for example, you might want to choose a strike price that is below this original short put down here and still get a credit. So the whole important thing is that you want to roll to a strike price where you can still get a net credit. So that's pretty much it. So this is method number one. As you can see, is pretty simple. So once you have exited it, all you got to do, go back to step one, rinse and repeat. So this is for method one. Now, method two. So method two, this is 100% based on the Tasty Trade studies, whereby they are always in the market. So what you got to do is very simple. So for this, you don't even have to time the market. At any point in time, just put on the 30 delta strike price, again, nearest to 45 DTE, and all this according to the Tasty Trade studies, because that's what they did in their studies. If we take a look at the 21 DTE, all they did was that they randomly entered into the trade, and then once it's at 21 DTE, they close it, they put it on again. And then once you reach 21 DTE, close it, they put it on again, and over time, it used this result. Now, step two, wait until 21 DTE again. So again, we want to wait until it's 21 DTE to decide what to do then. So there are two things that you can do. So the first one, if it's out of the money, simply just roll to the nearest 45 DTE at 30 deltas. So maybe the market has gone up. If it has gone up, then this short put will be in a very nice profit. So what you got to do, just close it and then reinstate back to the 30 deltas again. So most likely this time it will be at a higher strike price. Now, what if it is in the money? So if it's in the money, chances are that your short put would be in a loss. So if it's in a loss, this is where the short put has an advantage over the put credit spread because you can keep rolling it, right? And again, because this is the S&P 500, over the long term, the market wants to go up, you can eventually roll to a point whereby the market goes back up and your short put becomes out of the money again. So if it's in the money, either roll out to the nearest 45 DTE, keeping the same strike price, same as what we did in method one, or roll out to the nearest 45 DTE and down to a lower strike price. So in this case, you are lowering your strike and then you're giving a better chance for the market to eventually recover and have that short put be out of the money. So again, remember, this is always over the long term. So over the short term, you can definitely experience drawdown and losses. This is all part and parcel. But if you continue to put it on, and if you do this over the long term, because this is a positive drift vehicle, you're going to be yielding a positive result over the long term. All right, guys, so this is the short put strategy on SPLG. This is how you can partake in the S&P 500 index if you have a small account.